Well, welcome back to Managerial Accounting. The purpose of this little mini lecture is to review the multiple choice part of exam number 2. I'll do a separate little video on the take-home part. So the multiple choice part of the exam was worth 50 points. So I took the number you got correct, divided by 32. That produced a fraction. And then I multiplied that by 50 points, and that would give you the amount of points you scored on the multiple choice part. And then I would have added to it the points you scored on each of the 5 take-home questions, and we'll go over the 5 take-home questions in a separate video segment. So with multiple choice exams, you always got to think of what the right answer is first and then go looking for it. And then the other thing you got to bear in mind is sometimes in multiple choice questions, all the answers will look pretty good. And if that's the case, you have to take the best one. So with that background, let's take a look at question number 1. AirCo company is tempted to consider, they're tempted, evil there, they're tempted to do something wrong, to consider support department costs to be facility level costs that do not need to be applied to products. Which of the following is misguided in this approach? Well, the one that is the most misguided is that product costs would be inaccurate because support department costs may be used more heavily by some products than others. So if you get support departments and they are supporting various production departments, the amount of effort and energy they put into each of those production departments may not be the same. So the best answer there is C. Joint costs are inseparable. This is the story of Elmer the pig. Those are all the costs that were incurred to get Elmer off before he got dressed. So the joint costs are the costs that are incurred before split off, before Elmer went off to get dressed and came back from being a big fat little pig, a big fat pig, came back as ham, sausage, and bacon. So the answer there is A. Number 3, which of the following are the 4 common methods for allocating joint costs? Well, the 4 common methods, not necessarily in any order, are market value at split off, physical units, weighted average method, and net realizable value. Those are the main 4 methods of allocating joint costs. This one, number 4, I felt generous. I took 2 correct answers here. Under the net realizable value of allocating joint costs, which of the following equations is used to compute the value of products not processed beyond split off? So I thought that was a little bit tricky. So the actual, if a product valued not beyond split off, it would be the sales price at split off times the actual quantity. The actual formula that we use for most products is net realizable value will be the final selling price of the product times the quantity minus the additional processing costs would be used. So I recognized this one. I was, kind of very fine-tuned. So I accepted either A or C. A in this particular case is the more correct one because they're asking about a product that is not processed beyond split off. So therefore it would be the value you'd use to allocate it would just be the sales price at split off because there were no additional processing costs. But since we use net realizable value, normally there are processing costs. So, I would have accepted C, which is if you did have a processing cost, you'd take final selling price times quantity minus the additional processing cost. So either I was feeling generous, either A or C was accepted. A would have been the more correct answer. Number 5, which of the following is a drawback? Ooh, something wrong with this of using a single plant-wide rate to apply product costs. So if you use a single, what's the drawback of using a single plant-wide rate? Well, best answer there is B. A single driver used for all overhead costs is unlikely that driver select is appropriate for every type of overhead. So, some overhead is based, like janitorial costs are best allocated on the basis of square footage. Maybe cafeteria costs are best allocated on the basis of the number of people that eat and so forth. So the best drawback there is B. A single driver used for all overhead costs is unlikely to be the driver that is appropriate for every type of overhead. 6, which of the following explains why it is difficult to apply support department costs such as janitorial services to products? Well, you can probably make a case for some of these, but the best correct is appropriate cost drivers can be difficult, if not impossible, to determine. So that's the big challenge when allocating support department costs is to make sure you get the right driver. So the answer there is C. Number 7, Woodbridge manufactures food-grade wax-lined paper takeout containers. Doesn't that sound exciting? So we we manufacture takeout containers for a service industry for many popular restaurants, which the following is most likely a support department cost within Woodbridge. So if they're supplying, if they manufacture containers for takeout, so deli is likely to be a production department, deli container, sandwich container, salad container. Those are all going to be production departments. So the one that's likely to be a support department would be the janitorial department. It's an important cost, but that would have to be allocated. Janitorial costs would have to be allocated to those different departments. So answer there is B. 8, which of the following statements is true about the sequential method of allocating support department costs to production departments? So remember, with sequential, we take the largest support department cost, we allocate it to the other support department cost, if any, and then also to the production department. And we keep working our way down in sequence until we've allocated all the support department costs to production departments. So the one that best describes that is B. The sequential method captures some, but not all interdepartmental costs. So some departmental costs, if you allocate janitorial to the 2 production departments and the cafeteria department, you are allocating some of the costs to another department. And you do it in a series of steps. So B, the one that is the best answer here, sequential method captures some but not all of interdepartment costs by allocating support department to other departments and production departments in a series of steps. So that is indeed the definition of the sequential method. Number 9, and don't worry, I'm not going to sing Home on the Range again. Most of the decisions management focus on a narrow range of activity, which is called the relevant range of production. Relevant range of production would be that the range within which the company operates normally, and that's where you come up within that range. The fixed costs are this amount and the variable costs are this amount, but that's only applicable over the relevant range. So the relevant range, if you exceed capacity, for instance, you're beyond the relevant range. Number 10, the point where the profit line intersects the horizontal line on the profit value chart represents the break-even point. So break-even is the point where profits, where the revenues are equal to the costs. And so the point where the profit line intersects with the where are we here? Yeah, the point where the horizontal axis on the profit chart represents where the profit line intersects. The break-even point would be the point where it intersects. So take a look at one of your cost volume profit charts there. Okay, number 11. Technology fixed costs are 1,500,000, unit selling price 250, and variable costs are 130. The amount of sales required to not break even to have an operating cost of 200,000. So what you do there is you would take the fixed cost plus the operating profit and divide that by the contribution per unit. So 1,500,000 of fixed cost, $200,000 worth of profit. There's your sales price. There's your variable cost. So it's 14,167. So do the calculation, and there it is. So the answer there is A. 12. Which of the following would be classified as a fixed cost for a T-shirt manufacturer? So you're manufacturing T-shirts. So the electricity costs a certain amount per hour, hourly wages on sewing machine operators, cotton and polyester costs. Those are all variable costs. The one that would be, none of those would be actual fixed costs. So the answer there is D. Example of a fixed cost might be straight line depreciation on production equipment. 13, in a cost volume profit chart, the total cost line begins at the total fixed costs on the vertical axis. Okay, the total cost line begins at the total. So what will happen on the chart is you'll have a fixed cost, and then you'll have to get the variable cost will be a line up on top of that. All right, so the total cost line begins at the total fixed cost. So if you had no volume, you'd still have that fixed cost, and then it would if your variable cost was $10 per unit, it would sit on top of that and increase on that. So the answer there is C. 14, which of the following conditions would cause break-even point to increase? So remember, break-even point is fixed cost divided by the contribution per unit. So if you want the to increase the break-even point, you either reduce the sales price or you or increase the variable cost. So the answer there is D. A unit variable cost increase would cause the break-even point to increase as well, because you'd have to sell more units to break even. 15, as production increases, the fixed cost per unit goes down. So as production increases, fixed cost remains the same. So as you produce more units, then the fixed cost per unit, in fact, comes down. 16, which of the following is an example of a cost that stays the same as the number of units produced changes? Okay, well, electricity, direct material, and wages for assembly worker, those would all be considered variable costs, but the one that would remain the same, the fixed cost, would be straight line depreciation of the factory equipment, which would be the same amount of depreciation under the straight line method, no matter how many units you produce. So the answer there is C. 17, which of the following is a reason for easy identification and control of variable costs under the variable costing method? Okay, so which of these are true? Variable and fixed costs are reported separately. That's true. Variable costs can be controlled by operating management. That's true. Fixed costs, such as property assurance, are normally the responsibility of a higher level of management. That's true. So all of those things are true. Right? So we use variable costing often to evaluate the performance of managers, and in that regard, all A, B, and C are all true. So D is the correct answer. They're all true. Contribution margin ratio, that's a simple formula. That's contribution margin divided by sales. So go to the income statement. So take the sales minus the variable cost will give you the contribution margin, divide that by sales. So it's contribution margin divided by sales. Answer there, B. 19, the amount of income under absorption costing will equal the amount of income under variable costing when the units manufactured and the units sold is the same. Okay, so if the units manufactured is equal to the units sold, then you're going to have no difference between variable costing and absorption costing. Remember, the difference is going to come when you have a change in the inventory, because absorption costing is going to include in the cost of the inventory some fixed costs, which are going to be period cost under variable costing. 20, under variable costing, which of the following would be included in finished goods inventory? Well, what's included in finished goods inventory would be all the variable costs incurred. So it wouldn't include fixed costs, but it would include variable costs. So it would include wages for machine operators. It would include steel. It would include electricity. So all of the above would be included. What it wouldn't include would be fixed costs, but they didn't give us any fixed costs there. 21, the amount of income under the absorption costing will be more than the amount of income when under variable costing, when the number of units manufactured exceeds the number of units sold. If you have an increase in the inventory, then absorption costing is going to give you the higher net income. Variable costing will give you the higher net income when you actually sell more than you make. So the answer in this one here is A. So absorption costing will give you more income than variable costing when the units manufactured exceeds the units sold. 22, on the variable costing income statement, the figure representing the difference between manufacturing margin and contribution margin, that's the variable selling and administrative expenses. Here's where a couple of you lost points on the take-home part of the exam because you didn't show what the manufacturing margin was. So manufacturing margin minus the variable selling and administrative expenses gives you the contribution margin. So the difference between the figure representing the difference between manufacturing margin and contribution margin is indeed D, variable selling and administrative expenses. 23, which of the following would be an inappropriate activity for cost analysis in a service firm? Well, service firm, if you mow lawns, if you serve customers, if you give haircuts, those would be important, appropriate activity bases for a service organization. Service organization would not buy and sell inventory. So the one that would be inappropriate would be B, inventory produced. So if you're a service organization, you don't produce inventory. My wife is out at the hair cutter right now. There's not an inventory of haircuts. She goes in to get the service of getting a haircut. They don't maintain inventories. 24, which of the following is required by generally accepted accounting principles? So generally accepted accounting principles, when valuing the inventory, requires us to use absorption costing. Okay, so GAAP actually requires on the financial statements that we use absorption costing. You say, well, why are we teaching variable costing? Well, variable costing is often used to evaluate managers. And remember, we have to follow GAAP for financial reporting. We don't have to follow GAAP for those reports that we prepare for management to help them make decisions. Okay, number 25. HEDI is trying to decide how many units of merchandise to produce each month. The company policy is to have 20% of next month's inventory sales in inventory at the end of each month. Projected sales for August, September, and October are 30, 20, and 40. The number of units that must be produced in September as well. The number of units that would be produced in September would be the sales plus what you want to have in ending inventory minus what you had in beginning inventory. So the sales were 20,000 units. We would have had in ending inventory 20% of the sales. That's the amount that we would have wanted on hand, 20% of the 40,000. And the beginning inventory would be that which we would have had at the beginning of the month. And that would have been based on the previous month's sales of 20. So it's 20,000 plus 0.2 times 40 minus 0.2 times 20,000 gives us 24,000. And lo and behold, I do the calculation. I have confidence in my calculation. And I find the right answer. So it's 24,000 units. 25. Sales revenue is $1 million. Sales commissions are 5% of sales. Sales manager's salary is $80,000. Advertising are $65,000. Shipping expenses are 1% of sales, and miscellaneous and selling expenses are $2,100 plus 1% of sales. The selling expenses for the month are, well, you got to add all those up. So the selling expenses are the 5% of $1 million gives you 50,000. Sales manager's salary of 80, advertising expenses of 65, shipping of 1% of sales, so that's 1% of $1 million. Then you've got miscellaneous selling expenses of $2,100, and then 1%, and you get additional selling expense of 1% of sales. So add those all up, you get 217,000. 27, the company is preparing a cash budget. Its balance on January 1st, this is important, is 290,000, and its minimum cash requirement is 340,000. The following data have been provided. So the amount of deficiency or excess cash after considering the minimum cash balance required for January is what? Okay, so we know at the beginning of the period we had 290,000 because that's what they told us. Look down here in the yellow. We know we had cash receipts of 106,01200. We know we had cash payments of 984,500. So that gives us $366,000 worth of cash. The minimum cash that we had to have was 340. So we actually exceeded the minimum cash by 26,700. So the answer there is A. 28, which of the following is an integrated set of operating and financial budgets for a period of time? That's the master budget. So we say a budget is a numerical representation for management's plans for a period of time. So we budget the income statement, which we call the operating budget. We budget the balance sheet, which we call the financial budget. And if we put those all together, those are all part of the A master budget. 29, a disadvantage of static budgets. Static budgets are budgets that don't change based on volume. So they do not change on the basis of activity levels. Remember, when we introduced budget, we evaluated some poor manager on the basis of it, compared his results against a static budget, and we concluded that really wasn't fair because although he was over budget, he produced 10,000 more units than he was supposed to. So that's a limitation of a static budget. It does not allow for changes in activity levels. 30, which of the following estimates the number of units to be manufactured to meet budgeted sales and desired inventory levels? That is C, that is the production budget. 31, which of the following should be ignored when preparing a cash budget? We ignore depreciation expense because depreciation expense, you may remember from financial accounting, is a non-cash expense. When you record depreciation expense, you debit depreciation and you credit accumulated depreciation. So it's a non-cash expense. So when planning the cash budget, you do not consider depreciation expense because it's a non-cash item. And last but not least, you made it this far, the primary budget for a non-manufacturing business would be the staffing budget. So the answer there is D. Okay, so I hope you found that review useful, and I will do a separate little video on the take-home part of the exam. Overall, the exam results were pretty good. They were 5 points higher than the first exam, which is positive. A couple of you did real well. A couple of you did about the same. A couple of you went backwards a little bit. So if you went backwards a little bit, maybe you prepare for the first exam the same way you prepare for the third exam, the first way you did for the first. If you went up a bit, then maybe whatever you did for exam 2, continue to do. And if you went up a lot, like Chirini did, then maybe I would do what Chirini did and do the practice multiple choice, do the adaptive exercises and so forth. Again, the pattern was most people did better on the take-home part of the exam than they did on the multiple choice. Okay, au revoir, everybody. We will see you shortly in class. Bye-bye.